to be headed here. So let's go ahead and get started here. Now, before I do, just a quick disclaimer, what we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's first talk about where markets currently sit and how we think markets are going to move higher. So first of all, I think one of the things to remember is that the Fed has continued its buying. This is really why we continue to believe in our base case of markets will continue to move higher. This is in conjunction with more of the technicals that we've seen. So if you have joined us for the past few weeks, I've been talking about how I believe that markets are in a much healthier state than they were back in January and February. We had fairly strong participation in the broader market rally, small caps, equal weight, all joining in on the rally. We saw very, very healthy sector rotation during the rally that we saw back here from March to currently that we stand here today. And that's all supportive of these type of buy the dip opportunities. And that's exactly what we saw Thursday, Friday. I will say Friday started to look a little weak at the open, but we did manage to get back above 300. That was the level that we have been talking about for weeks and months. And yesterday we opened up below that and then managed to rally all the way up to 307. And it looks like we're about to open up another almost 10 points higher, 316. So we're almost reaching a lot of our short-term targets here to the upside. So this is exactly what I warned last week, is that yes, there are shorting opportunities when things are overbought that we saw back here on Tuesday and Wednesday, but I was very clear that when you look for short opportunities in this type of market, they last very, very short amount of time. So if you shorted on Thursday, you better have gotten out by Friday, or else you may not have been able to take profits on your shorts. And that's exactly what we're seeing here. And if you had some short positions held overnight, this might be a struggle getting out this morning at a profitable place, because a lot of those shorts have completely turned around. So these opportunities, again, as I spoke here last Tuesday, they're not great bearish opportunities. They're far better opportunities to buy the dip. So I hope some of you were able to take that and were able to place a few trades along those lines. But Fed continues to buy, so we believe markets are going to continue moving higher. We had a phenomenal buy the dip opportunity over the past couple of days, and the question comes back again: are we overbought? Are we overvalued? And the answer is, to some degree, yes. But so what? Markets can continue to be overbought and overvalued for quite some time, and those are the things we're going to discuss here today. So we're going to take a look at some retail sales numbers. We're going to look at some retail names specifically for our trade ideas. And then at the end, we'll try to answer some Q&A questions if we have a few minutes here at the end. So let's go ahead and get started. But the primary question or thing that I want to help investors understand is really what's the next upside target here for the markets, because we had this buy the dip opportunity and want to take a look at where are we headed next. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I'm going to try to disseminate some of the research that we're currently looking at and the ideas that we're paying attention to in the current markets, and predominantly how we're structuring trades around them, because things have shifted a little over the past few weeks and volatility has picked up, and that is going to shift kind of how we're positioning for this particular market. So the markets last week on Tuesday, we talked about how we started to reach these overbought conditions. We even helped you identify which sectors were most overbought and likely to have this check back. We did see some of that, or those were the sectors that pulled back. We reviewed some of those on Friday. And on Friday, we talked about how our base case was that this was not going to turn into a correction. We were keeping our eye out on the 300 level, and only on a meaningful break below 300 were we going to even think about seeking short opportunities. Our base case was that these types of dips that we're currently seeing tend to be very violent and quick, which is why we don't believe that shorting opportunities for these particular markets are great. You might have been able to pull a couple of shorts on this, but they were very short term in terms of how long they lasted. Our base case was always use these opportunities to buy. And that's exactly what we got here. We've roared back to life here. We're now trading, we're about to open up around 316, 3% higher from where we closed yesterday. So we really had only two real sessions of any declines, arguably only one real session of declines, and the other two sessions of fairly strong gains. So again, short positions only lasted 1, maybe 2 days at max, and you really had to get out. So that's the base case. Markets still resume what we consider a fairly healthy rally here, because markets can't just move higher without some type of check back. We had a check back very similar to this back here in late May, where you had 3 trading sessions that resolved itself within the 20-day moving average. We got the same 20-day moving average momentum resolving itself, and now markets are starting to move higher. And the question is, how much higher can we go? So I'm going to zoom into the S&P chart here. I'll point out a few levels that we're paying attention to. Now, I will say these levels are pretty much, we've pretty much reached these levels already. So 318, which is the gap fill here on the S&P, that's our first primary target to the upside. We're opening up at 315 right now, so I don't think 318 is going to take a long time. Our next target to the upside is that 323 high that we saw here back here just a few days ago. So those are our first and secondary targets. If we break above that, then we would certainly bring us back to that 339 level that we put in back here on February 19th. So 318, 323, and 339 are our upside targets here for the S&P 500. If we look at the NASDAQ 100 index, QQQ, managed to still be above, break back above its all-time high back here from February. So NASDAQ 100 index looking significantly stronger here. Markets have, looks like markets will likely reach that 248 all-time high here and potentially break out higher here on the NASDAQ 100 index. So those are the levels we're paying attention to. Predominantly technology still significantly stronger than the broader market. That is where I think you're going to focus some of your attention on. And we're also going to take a look at some of the retail names that we think are interesting for this particular play. Russell, the IWM, small caps also roaring back to life, significantly stronger here as well. Small caps actually, I think up a little higher pre-market than SPY. Let's take a look. Small caps up 4%. So again, this has been a bit of a surprise here for us as far as how strong small caps have come back to life. Some of this comes down to the Fed buying of small and medium type companies' debt. And this is what's caused some of the, I would say, strength in small caps, because we weren't expecting small caps to be as strong as the broader market. But as small caps have come back to life, this is again more support for this broader market rally. This is not just some house of cards that's being brought up by just a few mega cap names and everyone else being left behind. Small caps actually leading the market here. Technology leading the market. This is healthy, and we've seen sector rotation across the board that's healthy, where it's not just a few sectors rallying, it's really all the sectors rallying, not just the big names, but the small names within those sectors as well. So this is, again, support for our case that this is a buy the dip opportunity rather than a bear market rally. Now, VIX has ticked higher. Now, we've been talking about VIX for a while now. We've been talking about the 20-day moving average and how that's been a great selling opportunity for options. Now, we did get a break back above that 20-day moving average as a result of this recent pullback. But again, we've gotten a compression here involved. Now, because VIX is now trading at around 33 or so, which is roughly triple where it was trading back here in January, we certainly believe that at this moment that you may find better opportunities selling options rather than buying options, especially since the market momentum got kicked down a little as a result of the recent spike in cases and the market check back that we had over the past 3 days. There may be the speed at which the markets will likely continue to resume higher may be slower. So, and keep in mind that when VIX at 33, call options are not particularly cheap right now. So even though if you want to play for continued upside, call options are not cheap. So if you're buying calls, the stock needs to make a big move very quickly in order for you to be profitable or for you to overcome the break-even point. Versus selling options, because premiums are high, you're going to collect more premium. You're going to get a little bit more downside protection on that trade. And even if markets just grind their way higher, just a little bit slower than it was a few weeks ago, you're still going to be profitable on those types of positions. So with VIX spiking higher, we are now shifting our strategy, if you will. And this is really dynamic, right? Because a few weeks ago, we were talking about predominantly selling strategies. As VIX started to decline below 25, we started shifting to buying strategies. Now, and especially when markets reach all-time highs or relative highs, you want to buy options because you want to protect yourself to the downside. Now, with markets resolved itself again and volatility spiking higher again, now it's time to go back to selling options. And I know this is flip-flopping a lot very quickly, but that's how markets are changing very quickly right now. You have to be adaptable to the current market, and using the VIX is a great way to give you a better understanding as to how to play that. Crude certainly putting in a bit of a pause here right now. We found some support or resistance. Let's call it an equilibrium right now between 40 and 35. So right now, crude trading within this $35 to $40 range. This provides a little bit of stability right now. That means that we don't anticipate big gains in XLE or big declines in XLE until this oil either breaks out above or below this particular level. I will say that I don't have enough insight to give you an idea as far as which way I think it's going to break out, so I'm better off sitting on the sidelines here for XLE and looking for a move one way or another here in crude. So retail sales is going to be a primary, I would say, driver here today, especially with retail sales numbers coming out later today. Apparel, one of the strongest sectors, if you will, within the retail sales numbers. Air travel and department stores are starting to see some pickup. And one of the trends that have not moved at all, which is really public transportation and movie theaters. Movie theaters, not so surprising. Public transportation, that was my thesis regarding the Lyft trade. I think people are going to want to be transported and want to go out to places, especially as they've been stuck indoors for the past 3 months. But I think most people are not comfortable getting onto public transport. So Lyft specifically, I felt was the best suited name to benefit from this trend, if you will. So those are some of the trends that we're currently paying attention to. We have some apparel names to look at. We have some retail names to take a look at here today that I think might be an interesting play to look at. One of the other trends that I wanted to point us to is a clear uptick in terms of restaurant spend, number of seated diners at using OpenTable, which is an open source booking or open free booking site for you to book your restaurants. Now, one of the things I will note is that this number is fairly volatile. So notice how volatile this number is. It's not a very steady climb. And we've seen a significant decline as a result of the recent uptick of COVID-19 that caused a sell-off here last week. So be very careful as you think about restaurants, because it is one of the, I would say, reopening sectors that is relatively strong, because people are more likely to go out to a restaurant than get on a plane. And we've seen some significant uptick in terms of restaurants. So, this is about 20% off the lows. It reached about 25% off the lows here, down to about 70%. But as you can see, it's a very volatile number versus if you look at travel stocks are more likely only about 10% off the lows. So restaurant is actually on a significantly stronger trajectory. Just so you have to be very careful here in this particular sector, because it is fairly volatile. But I think that if you're looking for reopening, I think you're far better off looking at perhaps restaurant stocks than travel stocks. And I think travel stocks, we warned everyone here last Tuesday that we thought it went a little too far too fast. It's exactly what we got, is the biggest pullback in some of those travel names. But I will say the airline's looking pretty strong here this morning. So maybe they might be joining in on this rally as well. Now, the question about, are we overvalued? A lot of questions about this, not just in the past week, not just in the past month, for a while now. And what's interesting here is that the Bank of America recent survey of their fund managers actually confirms that. So if you feel that you are, you feel like a broken record saying that things are overvalued, why is everyone buying? You're not alone. Professional money managers feel the same way. And it's actually at all-time highs going back to 1998. 78% of fund managers believe that markets are overvalued. However, markets can remain overvalued for long periods of time. So that in itself, not a good reason to go outright or short the markets or buy protection per se. And some of the research I want to show you is what happens after the markets move 10% higher, as we saw here back in May. And the answer is, after a 10% move higher, the average 1 month move is pretty muted here. About 50% of the time the markets are flat. But 3, 6, and 12 months out, they are very strongly positive, 4%, 11%, 13%. And look at the statistics, 72% of the time after 3 months, it's positive, 81% after 6 months, 81% after 12 months, it is higher. So significant statistics to show us that even though markets can be overvalued after, especially overbought, right? If the markets move 10% in a single month, likely they are overbought. But the statistics show that after that, likely markets continue higher. So be careful as you're thinking about, things are overbought, things are overvalued, I should go out and short this market. Be very careful about that. If you're going to be short, be very selective, and also make sure that you take profits very relatively quickly, as you may have seen this over the past couple of days. So some of the names that I want to pay attention to here, investment grade bonds. This is number one on our list because this is what the Fed has been buying. This is also part of why we see equity markets continue to move higher, because as the Fed continues to buy treasuries, as it continues to buy investment grade, as it continues to buy high yield grade, and now not only are they buying the ETFs, they're starting to buy directly on the primary markets. What does this do? This certainly provides a support for these names. So if you're long these names, that certainly is what we call the Fed put, meaning you can buy investment grade, you can even buy high yield and feel fairly confident that the Fed will continue to support these markets. You're not going to get this significant sell-off, this liquidity crunch that we got here as a result of, the Fed not being in the markets at that time. However, what that also does is it compresses the yields on these types of fixed income names. So if you traditionally used fixed income names like LQD, HYG to generate yield for your portfolio, guess what? Those yields are now significantly lower because the prices have been bid up or bid higher as the Fed buying. And so a lot of the questions around how does the equity markets continue to move higher if the Fed's not buying it directly? And the answer is the Fed's not buying equities directly, but indirectly by buying all the investment grade bonds and all the fixed income bonds, the yields on that have been getting lower and lower. And guess what? Investors that are seeking yield are having to move to the equity markets in order to find that yield, because equity markets are generating roughly almost 10 times the yield of a 2-year treasury bond. So if you're looking for yield, you're going to naturally move into equities. So that is why we've seen the support here in equities as a result of the Fed, quote unquote, buying, even though they're not actually buying equities directly. So LQD, back at 134, major resistance level that it put in back here in February. Looks like we're about to get a breakout here. So if you are invested in these types of investment grade bonds, you might see a continuation higher here in LQD. So an important one to take a look at. Similar chart in HYG, certainly not at all-time highs here, but if you look at TLT, if you look at LQD, if you look at HYG across the board, you're going to likely see support of these types of names continuing to move higher. Now, I do want to point out Tesla, since a lot of people ask about Tesla. Tesla put in a pretty major $900 resistance level that has predominantly been resistance for a long time. Finally broke out above it, came back to retest that as support yesterday, and is likely going to now resume its continuation higher. And I think now that it gets back above 1,000, it's going to be in the news a lot. We've seen a lot of day traders trade this particular name, a lot of Robinhood, a lot of margin day trading in this particular name. So very volatile, but likely the type of name that's going to see some continued momentum, especially as it pushes above 1,000 here on Tesla. I also want to point us to Apple, because I think Apple is definitely going to be one of the net beneficiaries of this market moving higher. It is by far, it is the largest by market cap. And the fact that Apple seems to have diversified their businesses quite a bit within the retail space into more streaming, into more selling services rather just hardware. And I think they're still doing fairly well on their hardware business as they kind of adapt to a new world of providing credit to people buying iPhones, so that you don't necessarily need $1,000 to buy an iPhone. You can pay it off over time, really adapting to the times. And I think this is the market providing support for stocks like Apple to continue to move higher above that 330 level, as it found some support and has bled off some of that momentum over the past few weeks. Another name in the apparel space that we normally look at Nike as a strong correlation here to apparel, but Lululemon has really come back to life. Come back to life in a big way since COVID-19, as people work out from home as opposed to go out to the gym. This is a name that has really taken off here. But what we've saw here is a bit of consolidation here in the 320 level, came back to retest that 20-day moving average as support. And I think that is the pullback, if you will, or the consolidation it needed before I can continue moving higher. And that's likely what I think we might see in a name here like Lululemon. But again, with these types of names, if you go outright buying a call option here in Lululemon, it's going to cost you a pretty penny. Now, that pretty penny is likely going to cost you all the way up to that all-time high just to break even. So buying an at-the-money call that expires in July costs you 20 bucks. So the stock needs to make an all-time high in order just for you to break even. That's the concern that I have right now about playing to the long side, is just how expensive call options are. My preference here is to predominantly consider selling option strategies instead. So selling a 20-point wide credit spread, 302, 282 and a half, 20-point wide credit spread collects $8.15, which is about 40% of the width. Now, for those of you that follow me on my credit spreads and some of the education that we do on credit spreads, you know that we're always trying to collect roughly 1/3 of the width. So here, when you're collecting 40% of the width, that provides you with a large downside protection and increases your potential reward, and at the same time decreases your risk substantially on a name like this. So when you're thinking about these types of names, start thinking it from an option selling perspective, especially when vol is relatively high, rather than buying options, because options are very expensive. Amazon, another very constructive chart in my opinion here. You have this bullish triangle, if you will, that it managed to resolve this, that managed to resolve itself over the past couple of months or so, managed to just break out above that $2,500 level, went a little too far too fast, went parabolic, now came back to kind of to reality, if you will, back to 2,500, and just bounced off of that yesterday. So this might be the constructive move, if you will, that we needed to see, or the consolidation that we needed to see on that breakout for it to continue higher back up to that $2,700 level. If it breaks back above $2,700 level, I think Amazon is probably headed towards 3,000 after that. So keep an eye out on this, especially with retail being relatively strong and COVID-19 uptick still being a big concern for a lot of investors and consumers. Amazon's certainly going to be one of the net beneficiaries, both from their Azure cloud business as well as their retail sales business. Goldman Sachs, this is a financial, I'm not particularly bullish here on financials, simply because the rally that we saw here, the strength that we saw here over the past few weeks, from my perspective, was a bit of a fluke. It really came down to treasury yields taking off for a short period of time, as if we look at 10-year yields, 10-year yields took off here a couple of weeks ago, basically on optimism that things were going to reopen significantly stronger, and that we were on a risk-on environment, and people sold off treasuries to buy equities. And that quickly got turned around as the COVID-19 cases uptick started to come back, and people started buying safe haven assets like treasuries again. So the rally that we saw in financials was really tied more so to this move in yields rather than anything else. And now that yields are back to its lower levels, we certainly see 10-year treasuries starting to move a little higher here, but financials not particularly strong in my opinion as a result of the yields still being relatively low. But Goldman Sachs has really started to come back to life here over the past couple of weeks here as it moves back above the 200 level. One of the things about Goldman is the fact that it's managed to break back above its 20-day moving average. Again, similar to Lululemon, I don't necessarily expect a big move to the upside. So my preference here would be to sell options instead, because if you look at Goldman Sachs options, they also are very expensive here. So you would need a pretty big move to the upside just to break even, about 15 bucks. So Goldman Sachs needs to make it all the way back up to its all-time highs and higher just for you to break even. Now, I don't know that I think that's a pretty big move to the upside. I don't necessarily know that you're going to get that big of a move so quickly. So my preference again here is to sell options versus buying. Now, one thing I do want to point us to is Brazil. Brazil has been, interestingly enough, fairly, has been obviously one of the countries that have been devastated by COVID-19 and still continuing to see an uptick in terms of cases. But I think equity markets are telling us that this is starting to turn a corner a bit here, as we had this nice rally off of that breakout above $26 level, came back to retest this 20-day moving average, and now likely is starting to move a little higher here. Again, limited upside here in Brazil, but as things start to turn a corner, as the number of cases start to flatten out, this is certainly one of the countries that you may see some upside moves, some outsized moves to the upside here in Brazil. And lastly, SLV silver. This is something that that's been on our radar for quite a few weeks now. We've been talking about it since the breakout here above $15 or so. It has spent the last couple of weeks really consolidating here between 15 and 17. So one of the things that we are looking for is for silver to come off, bounce off this 20-day moving average, resume back to that $17 level. If you look at the weekly chart here, 1750 is a major resistance level here. So I think that upside targets here is around 17 and 17 and a half to the upside. If we do manage to break it back above 17 and a half, then you have a much larger move to the upside potentially here for SLV. I don't think that's necessarily going to happen, but hard to say at the moment. Right now, we're targeting that 17 and 17 and a half here to the upside here for silver. So those are the charts that we're currently paying attention to and looking at. Like I said, markets are significantly healthier than they were back here in January. We see it across the board. This is something that we've been talking about for weeks, about how equal weight, market cap weight, small cap, value, growth, sector rotation is relatively healthy. That supports our base case of using these opportunities to buy the dip rather than potentially the start of a major correction, especially if you look at what the Fed is currently doing with the fixed income markets. That is, again, supportive of flow moving into equities, as investors seeking yield find it very difficult to find them in the fixed income markets. It is supportive of the markets, and that's why we continue to take our base case of buying these dips. But again, the sell-off that we've seen over the past few days has taken a lot of the momentum out of the markets. We certainly see some of that here today. I don't know necessarily if that's going to stay. This momentum might fizzle out a little. It looks like pre-market, it got back up to about 316, 317, has already pulled back a little bit before the open right here around 315, but certainly very strong. 318 and 323 are some targets that we see to the upside that we might hit, this week very easily, but that rally might very easily stall at those levels as well. So be careful as far as how you're positioning here for this market. Things can turn around relatively quickly, but again, our base case still here is to buy those dips, and arguably that opportunity is already over largely as the markets continue to move much higher here into the open. So with that, I want to thank everyone for taking the time out here this morning. I hope that this was useful in helping you get a better understanding as to how to position for this market. I will say that a quick announcement, we do have a schedule change here for this Thursday, for our Thursday, or not a schedule change, but a change, because I have a very special guest here on Thursday. I actually have Tom Sosnoff with me again this Thursday. So for those of you that had enjoyed him back here in January, but we missed him in March because of COVID-19, he is back here this Thursday. So I'm very happy to have him with us. We're going to talk about the markets. You're going to be able to ask him questions regarding how he's trading the markets. I will post a link here later today to allow you guys to submit questions for Tom Sosnoff, but I hope that you guys are able to join me this Thursday for that very special session. I'm very excited about having him here. And again, a big thank you to all of our members for supporting us to allow us to continue putting out this research every Tuesday and Friday and helping you better understand how to position for these markets. For those of you that are not members yet and you're thinking about joining, you can use this link here. It's just $75 a month or $500 a year. I've just posted a link here into the chat window for those of you to take a look at to sign up for a membership. So again, thank you so much. We will send out the recording here in a few minutes as soon as we're done here. So thank you so much. I hope you guys have a great afternoon, and I'll see you guys here on Thursday.